Good morning, everyone. It's Friday morning, and we're going to do a video today to show. We're going to recap just the long-term chart. It's just real quick because it's getting to be like beating a dead cat, waiting for something to happen, show us what's going on. But there's some really interesting, for training purposes, to show people how precise the Elliott and the Fibonacci can work on the short-term charts, long-term too, but our demonstration today will cover short-term. So to start with, this is the S&P 500, the index, going all the way back to the 2009 low, 2007 high, and how we are counting a large ABC rally. So far, it still counts as an ABC rally, and this is the decline that just took place. This is the ending diagonal that we counted as wave 5. So far it still is the high. The market's not helping to give any indications of a reversal, and this drop right here will show you, see this trend line from the wave 2 and connecting these lows here, and you can see that the market just came down and held this. Now, this is in the S&P. Other indexes broke this line, and even the Dow did much more technical damage, but working with the S&P, which is what we do most. And then another, besides holding this trend line, which was key, I'll show you how do a Fibonacci retracement from the wave 2 low to the high of the diagonal, and you see that the market dropped 27.2%, which is a key Fibonacci retracement target for a fourth wave. So those are the two most compelling pieces of technical data that we have, indicating that this may be intermediate wave 4. So we would move this over here, and this would be intermediate wave 5 to finally end all this mess. And this trend line goes all the way back to the 2007 top, comes up to the top of the ending diagonal. So this would be a good target if the market makes new highs, but we haven't made new highs yet, and the wave count is so ambivalent that we can't state emphatically that we are going to see new highs. So we just keep watching and waiting. We keep trading the short-term waves until we see more information. So let's scoot this chart over. And bam, we have another chart up here. Technologies, incredible. Here's the diagonal that we've shown a million times, how it counts. Also, the Wilshire made a new high. Its all-time high was made right here. So it's possible that the S&P made a truncated fifth wave right here, as we've gone over 100 times. It's possible that the S&P made a truncated fifth wave right here. And it's also possible that the S&P topped out right here, and these aren't truncated fifth waves to match the Wilshire and the global Dow. So we just have to sit and watch and wait for more information, more data, more wave counts. But if it is, if this is a truncated fifth wave right here, it would count as wave 1, wave 2, wave 3 down, wave 4, and another truncated fifth wave here to make minor wave 1. And that would also be matching the Wilshire. And we don't put a whole lot of emphasis on that, whole lot of possibility percentage that that's what's taking place. We'll know sometime next year if that's what happened, but for right now, there's no way we're going to place large betting on that. If the S&P topped out right here at its all-time high, This clearly counts as an ABC for A, wave B, and then a wave C down for a three-wave correction, which would match the long-term chart that we just showed if this becomes intermediate wave 4 and the market's pushing to a intermediate wave 5 high, new all-time high. Another way that this mess here, 1, 2, 3, 4, and 5 waves down, could be a leading diagonal pattern. Sloppy. The normal wedge-shaped trend lines that you would draw to indicate the leading diagonal don't work. And this new high right here above this high right here actually discounts it being counted as a leading diagonal. So with all that being said, this looks more like a correction than it does anything, unless the S&P is really following with the broader based indexes, and these do really turn out to be truncated fifth waves. But for now, we'll work with what we've got. Even if we make this a minor wave 1, the Wilshire made a new low right here, so its wave 1 would be right here. S&P, if we make this a wave 1 here, market's doing an ABC. This would match what the Wilshire's doing, and we have a minor wave 2 in place here, which was almost a full retest of the previous highs. That's the way indexes do. The Wilshire made a new low here, so its ABC starts from here and goes A up, B down, 5 waves of C up to here for its 2-wave correction. And by the way, the Wilshire hasn't retraced near as much of the initial decline here. It hasn't come up near as far as the S&P has, or the Dow. So it's possible that the S&P makes new highs and actually forms intermediate wave 5 of primary wave C at another new all-time high that would be unconfirmed by the broader indexes, and we would have intermarket non-confirmations, which would be huge sell signals. But for now, we have to wait and watch, but that is something we'll be monitoring if and when it does happen. So that's all for this stuff everybody's heard over and over and over again. Nothing's changed. We do have more pieces of the puzzle to put together here. If a high is in place, wave 2 ended right here, we do have a nice looking leading diagonal here. You can see how the diagonal trend lines usually make a wedge-shaped formation, and you can see how each low just stayed right on the lower trend line. That does qualify it for a leading diagonal, and that would be wave 1 because of the distance and the size at the sub-minuet degree. And this is an ABC wave 2 at the sub-minuet degree. Now one thing, the Dow almost made a new high right here today, whereas the S&P didn't. So it's getting really close to violating, and this would just become an ABC correction. And there was an overlap. The market did overlap this price high right here, which means this would be wave 1, this would be ABC wave 2, this would be 5 waves of 3, this would be 4, and now we're in the process of moving to 5 waves to a new high. But the internal wave count for the time being doesn't allow the market enough to get to new highs. It could break this high right here but not make a new all-time high. So we've got all kinds of things to be watching. We need confirmation in short term, long term, everywhere. So we'll just continue keeping up with each move the market makes. Now I'm going to reach over here and grab another chart. Stay with me. Let's see here. So here is the short term, or shorter term, and this shows the leading diagonal off the minor two wave high, and how it breaks down, how it counts. And it, like I say, it does create a nice leading diagonal. Have a diagonal for wave 1, ABC for wave 2, wave 3, ABC for wave 4, and then 5 waves of wave 5 to complete wave 1. And then we also showed the alternate here. This would be minor wave 4, and we're headed up in minor wave 5 to complete intermediate wave 5. And this is what the ABC looks like so far. 5 waves of A, 3 waves of B, and as of today, 5 waves of C. And that would complete wave 2, and now the market's ready to turn down, but it needs to turn down another more highs here, and we'll have a 5-wave pattern. But like we were saying, this 5 waves here doesn't support. Wave 3 did become, if this is wave 3 right here, it did become longer than wave 1 right here today. So that means that wave 5 can be as long as it needs to be. So it could extend in 5 waves. They could reach all the way up in a bubble blow off top in an extended 5th wave above 2130 to make a new high. But that's just speculation. No way we'll trade that. We'll just wait and watch, see if that's what happens. There's not really any reason to make a new high here, or make a new high above here and not make a new all-time high and create a 5-wave pattern right here, because that wouldn't fit anything. So that's why the jury is still out what's going to take place here. But this is what we really wanted to show everyone today, is how precise the market can be in these short-term gyrations, and which also works for the long term. You do the same calculations the same way. Each degree of wave has its own set of calculations. You had 5 waves here, use the same calculations, and you had an ABC correction. You had 5 waves up to here, small pullback, ABC pullback here, 5 waves up to here, and then on Thursday we spent the whole day doing an ABCDE wave 4 triangle, which is shown right here. We sent a chart out. We didn't have the microwaves, the blue ABCDE. We just had the little trend lines, and anytime you see these lines that look like this, that's what they represent as a triangle pattern. So the triangle apexed right here at this little red line at 2079.50 on Thursday afternoon, and we actually bought the close on Thursday afternoon, and our really active traders we were trading with also bought, and we had our stops. Our stops were a precise calculation, because if this was a triangle, the overnight lows Thursday night wouldn't have broke, and our risk was really small. And what takes place after a triangle is a thrust out of the triangle. So that's what we were betting on Thursday afternoon, is that the market did create the triangle. Friday morning, or sometime Friday, there would be a large thrust straight up. Well, that's what happened, as you can see right on the open. The exact rules for the triangle took place, and the market traded up to the high of the day. And we made a good trade. We also were able to calculate exactly where the market would go to, which is what we're going to show you now, how we did it, and allowed us to get short for a move back down all day today into the area of the triangle, and that's what happened. So Elliott's rules worked flawlessly. So here, after you do a triangle, let me change the time frame on this so you can see better. Let's see, it's 15. Let's go to a 5-minute. Okay, here we go. So now you can see the triangle better. We did ABC down for wave A, ABC up for wave B, ABC down wave C, ABC up for wave D, and then a small ABC down for wave E, and this was going into the close Thursday. And this is a double bottom low right here for wave C and wave E. So when we bought at the close on Thursday for the overnight session, the market closed right here, and our stops were right there. Because if the market went down Friday morning and broke, then this wasn't a triangle. Our risk was real small. And what we were betting on was that the triangle did take place and that there would be a large move up Friday morning, and that's exactly what we got. It's amazing how Elliott saw this take place 80 years ago and happened this exact same way. So what we have here, we take here's our wave 1, and this would be our wave 5 out of the triangle. So let's measure wave 1. Go down here. Let's see, get over here and do a Fibonacci extension. So we measure our wave 1 right there, and then the top of wave 1 right here. Now wave 3 was actually a little bit, like just a few ticks shorter than wave 1 of the same degree of this move here. So that tells us that out of this triangle, wave 5 can't be as long as wave 3 was. So that gives you a predefined distance that wave 5 would be if it extended the maximum. It couldn't be as long as wave 3, because wave 3's all got to be can't be the shortest wave in an impulse move. So we come down here to the apex, and we calculate the apex by taking the distance of the A wave, the largest distance within the triangle. Cut it in half. That gives us 79.50. Place our extension right there. Fifth waves, 75% of the time, at least, or 85% of the time, are 61.8% of the one wave. And as you can see here, the high of the day was 2094.50, and that's exactly what the 61.8% number is, 2094.50. So that's one way that we came up with the 2094.50 high, and how we told traders that we'd take profits on our longs. Actually, we didn't take profits on our longs there. We took profits on our longs right after the market opened and started right up here. We didn't risk waiting to see if that number was going to be hit or not. We went ahead and took our profits, waited for that calculation to be hit, and then placed our short trades, because the risk once again was extremely limited. So that's how 61.8% from the apex of the triangle was the exact target for wave 5. There's one other way to calculate it. I'll erase this and we'll show you the 5 waves at this degree here. This is the micro degree. 5 waves at the micro degree here for wave 3. 1, 2, 3, 4, and 5. And 5 waves of the micro degree, wave 1. So each degree, fifth waves have a relationship to the first wave, and third waves have the relationship to the first wave, and a few variations of that. So once again, right here, this is 5 waves. This is wave 1, really clearly defined. Wave 2, and then if you look at a tick chart, you see 5 waves up of wave 3 after the blast off this morning. Then you see wave 4, then you see wave 5 right here. So if this small wave 5 right here is going to have a relationship to the one wave right here, there again we take our measurements, our Fibonacci extensions, place it at the bottom of the one wave, at the top of the one wave. It's hard to get right on that, right there, and then we look for our distance for 5 equals 1, That's not exact, that's not precise, because I'm using let me expand this a little bit so you can see. And right here you can see that equality, fifth wave equality to the one wave of the same degree is 2094.43. Now actually, if we would have expanded the chart and made our calculations, you would have seen that the high right here was 2094.50 for 5 equals 1 right here. So you had two calculations, one in the fifth wave of the same degree of this move right here, and then the other one, the larger degree, 61.8% of the larger degree, wave 1. Both calculations were hit at 2094.50, and we got a good short trade out of it. And that's the way we've been trading through this whole mess, and that's the way we'll continue to trade, watching for these short-term wave counts and these perfect calculations, these junctures that are hit like this. Because the long-term wave count has more to do to show us what's going to happen. We're either going to get a fifth wave to new highs, or we're not, and the market's going to collapse. But we'll be ready when it does. So remember how we did this, because this is extremely valuable for day trading. We talked to over 100 traders today, and all 100 traders are professional traders, meaning they make a living and have made a living their entire careers from trading. They all use different systems, pivot points, daily pivot points, long-term, short-term, intraday, moving averages, calculations, algorithms, they all use. But when I ask them today, all of the 100 traders, I asked them if their systems gave them a precise top for the day at 2094.50. I didn't get a yes or an explanation or a video or a screenshot or anything showing how it was calculated. This is the only way that it can be done. And all we can say is for those hedge fund managers out there that are losing money this year, they really need to change their opinion and see just how powerful Elliott and Fibonacci is. So you have to include this into your trading regardless of whatever else it is you use. You have to learn how to incorporate this into your system. So that's all for today. We'll be out and in all next week. Thanksgiving. Hope everybody has a safe trip if they're going out of town, and don't eat too much, and have a happy holiday. And talk to you next week.